You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome to Real Investor Radio. This is Craig Fuhr. I'm joined here today again by my co-host, Jack Bevere. Jack, good to see you.
Absolutely. Good morning, sir.
It appears that we are up to episodes 20 and 21 today. Looking forward to jumping in. We have a very special guest. I just can't wait to jump into the conversation. But Jack, for the folks who are just tuning in, you and I had a pretty good discussion on the last couple podcasts regarding the market in general, where things are heading, sort of some of our prognostications and predictions, as well as the Airbnb bust that everyone is talking about these days. So I'd encourage everybody who is tuning in for the first time, or maybe even for the second or third, to go back and check out those last two episodes, because I think it was a pretty lively discussion. Jack and I don't always agree on where the market's heading, so that we had a pretty lively debate there. So yeah. So how you been, man? Good?
Good. Absolutely. It's been it's good that we release these podcasts on a timely basis, because the world seems to be changing very quickly, like on a week over week basis. We had a huge run up in treasury rates last week. Wall Street's freaking out. The tone in the world's getting a little bit more pessimistic. And so it was super timely that we were able to get our guest today on, because she's got some strong contrarian opinions about this stuff that I'm excited to get into.
Yeah, we'll introduce her in just a second. But with regards to the market, I was watching an interesting interview yesterday where the gentleman who was giving the presentation sort of went through some key economic indicators that without exception point to recession. And Jack, I'm not really familiar with this first one here, so maybe you can jump in on this one. It's the 2s and 10s. So it's the 2-year yield versus the 10-year yield, and sort of looking at the 30-week moving average. Once it crosses above the 30-week moving average, that indicator, it is a 100% probability of a recession. It's never been wrong in the past, and so that average has now moved above the 30-week moving average. The second indicator that he mentioned, which is not always a precise predictor of recession, would be just consumer sentiment. And so it's basically, future expectations minus current situation. And I think that we could all agree that the consumers are sort of, there's a lackluster sentiment about the future. And I think a lot of people are very nervous about our situation today with a second war in Israel. People are now talking about Taiwan and China, potentially invading Taiwan. So I think there's just a lot of anxiousness in the market. And then finally, the third indicator was unemployment. And it's still obviously low, Jack, but it has crossed, it is ticking up, and it's crossed above the 12-month moving average. And once it goes above the 36-month moving average, that is a 100% probability historically of recession. So we're not there yet, but it's ticking up. And one of the big indicators that I've been reading more and more about, Jack, is these zombie corporations out there. These people who are basically borrowing to pay their interest, and these companies, I should say, and that they're all by 2025, they're all going to have to refi their debt, their corporate debt, at a rate that is now going to be double what their current rate is. And by the way, these companies that have to do this, Jack, employ over 11 million Americans. We're talking about refinancing close to $2 trillion in corporate debt by 2025. And these companies employ 11 million Americans. So with that, maybe get your overview on just as we move on, Jack. But I would go ahead.
Yeah. I think the tone is getting definitely more pessimistic. All the indicators that you just described being, primary drivers of that. At the same time, I think this morning, the GDP numbers came out, and the country's growing at, I think it was like a 4.9% GDP growth rate for the year, which is incredibly strong. And so it's really odd because we've been I feel like we've been talking for over a year about this recession that's coming, right? In April, there was a recession coming in 6 months. In October of 2022, there was a recession coming in 6 months. In April of 2023, there was a recession coming in 6 months. And the strength of the consumer has just punted and punted and punted that idea. And I feel like we may be even be getting to a place where investors are, it's the boy who cried wolf, right? Like, there, I think a certain segment of the population is just like, they've been talking about recession. This is just clickbait. Like, this is never actually going to get here. Because the consumer just continues to defy all of these prognostications. I just got back from Miami. I was down at the asset based securities conference down in Miami. Because we did a securitization a couple years ago, so we're very interested in what's going on with that market. It affects both the SCR and fix and flip loan pricing. So we try to stay in front of those crowds as well. And something that struck me was they had three economists as kind of like one of their keynote macro economist panels, and I was frankly shocked by the consensus, the fact that the panel on the stage had a consensus view that we are going into a recession still. We're not gonna soft land this thing. um, you know 2 months ago, there was a lot of soft landing talk. I think that's turned, 6 months ago, it was 50-50. 3 months ago, it was, we're going to soft land this. Today, it's turned, we're not going to soft land this. And the impact of a recession, I think, is the X factor. The consumer has been what has allowed the economy to punt and punt and punt. And housing prices have stayed up. And so the consumer has been the engine, the fuel to allow us to continue to have a good economy. But even the Wall Street folks now are, kind of consensus planning for a third quarter of next year recession. I'm sure we'll get into some of the, I'm sure I'll bring up some of the reasons why. I don't want to go off on a long tirade here, but
Sure.
The reasoning behind why they were saying this is, what has happened. Here's why it's been that way, but here's why we're going to run out, and
Sure.
approximately when, was a compelling argument that really kind of changed my tune. So even from 2 weeks ago when we were having that debate, I think I've probably gotten a little bit more pessimistic since then as well. So
You and our previous guest Logan Mohtashami were just absolute bulls on the market, and so it's funny to hear your changing sentiments. But let's go ahead and bring in our guest today. I'm so excited to have her. Melody, welcome to the show.
Thank you so much, and thank you for having me.
It's just such a pleasure. So, folks, this is Melody Wright. Melody is a 24-year veteran in the banking and financial services industry. She was recently named as one of Mortgage Women magazine's Women of Technology, and she's a contributing writer for multiple publications. I was introduced to Melody through my research and for the show, and just sort of my general reading and watching through a pretty awesome article that you did for Housing Wire called "Debunking the Housing Inventory Myth," which we'll get into today. And it's obviously a article that is creating a lot of controversy and sparking a lot of debate in the industry. So we're just so delighted to have you, Melody. Thanks for taking the time.
Yes, and thank you so much for having me. It's a pleasure to be here.
Yeah, thanks. So, listen, Jack and I are longtime residential real estate investors. Jack, certainly far more than me, but we've invested in residential real estate all around the country. The Dominion Group, as you know, is also one of the nation's largest lenders of DSCR and bridge loans. And so that's sort of our jumping off point today in terms of what we hope to cover with you, and just
Sure.
really like to have just a general debate on where the market is, where you're seeing residential around the country, and where you think it's heading. So
Sure.
jump on in. We can just jump off there. Maybe you
Sure.
could tell us quickly about how you've come to some of your findings and some
Sure.
the way you feel about the market.
Sure. Yeah. So just a quick intro, I fell into mortgage finance and housing in 2006 by accident, which is how most people end up in mortgage. And right as things were topping, my company got purchased by private equity, Cerberus. So we actually led all the write downs of the crisis because Cerberus was looking for a purchase price adjustment because they could see the writing on the wall. Things were slowing down. And so I kind of became their girl Friday, going out across the company, teaching them how the company ran by gathering a lot of management reports. So as they learned, I kind of learned as well. And I got like a crazy education during that time period that I think I got a lifetime of education because it was just so intense. You'd walk into the office, we're writing down another 800 million today, things like that. So it was just a crazy, crazy time. But I started in mortgage finance where I really understood the intricacies of how, origination work together with servicing. And servicing is that back end, like after you originate your loan, that's the taking of your payments. So, fast forward, uh, we got into a lot of trouble, with the Federal Reserve consent order, the Attorney General settlement on servicing practices. I sort of helped manage that, got to get real familiar with how this entire thing worked from beginning to end. And then we kind of went into bankruptcy as well. And from there, to kind of keep our assets safe, I basically got tapped on the shoulder to run default and clean that up. So, because at the time at GMAC where I was, we had over 65,000 foreclosures, and something had to be done. We were getting threatened by Fannie Mae and Freddie Mac that they were going to pull servicing if we didn't, get rid of a certain percentage of our seriously delinquent loans. As I'm sure you guys know, the way that was affected. Yeah.
I was going to say, they must have really loved you. Boy, lucky you, huh?
Yeah. Oh, my Fannie rep won an award that year because it was just a problem. The way that problem was solved is essentially a lot of the investors came in and started participating, with Fannie and Freddie in the auctions, kind of offloading those properties. We had tried loss mitigation options, and honestly, I think that what people forget about that crisis is that there was a lot of investor speculation then as well, between like 23 and 26%. Now we're at about 30%. Depending on the market, it could be more. But I think a lot of people think subprime is like low credit. And in reality, it was a lot of non-traditional products, like a lot of things like a DSCR loan, kind of the Alt-A loans, et cetera. And so, in reality, a lot of the inventory wasn't inventory of prime borrowers. Now, later in the cycle, it became that. But there was so much investor speculation, and that kind of Wall Street kind of came in, started buying those up to do long-term rental. So from there, I kind of went out and worked at several non-bank origination and servicing companies, trying to help get them up to where, sort of meet regulatory guidelines. Got very frustrated in the industry because the technology is so abysmal. Basically their core systems were created in 1968, 1972. It's just insane. You walk around some of these places today and it's blue and black screens still. So I went out to fintech companies and try, and it's so true, guys. And the paper, don't get me started on the paper. I can't even talk about the paper, but I went out, tried to build all these solutions to help the industry because I really believed we could do this right. I believe that. But ultimately, to really change the game, the entire industry would have to be disrupted, and people just weren't at a place. They weren't willing to do that. And then we kind of hit that COVID boom. And I was working at a fintech, and he kind of said, "Hey, listen, I need to understand when rates are going up because this is so crazy. It's awesome. We're making a lot of money." And so I really started diving into macro, and I've spent, the last kind of 3 or 4 years just getting a crash course kind of education in the business cycle, in macroeconomics. What are the drivers? I was very familiar with what drove our business, but I didn't really understand our business in context of the economy. And that's really kind of what I started looking into. And, for the longest time, I thought mortgage was going to be totally fine. It's not even a big part of my thesis, but what I came to understand is essentially, a lot of the lending was done on inflated credit scores, and then the Fannie Freddie models that most people use, because 95% of origination, is backed by the agencies or Ginnie Mae, right? So 5% private. That's kind of a flip from what it used to be. But essentially, I realized too that we were probably going to have a little bit of trouble in mortgage, but this all brings me to probably last January. I wrote that article, and I was just seeing a lot of themes. The biggest theme that I thought people were missing were our demographics. But I was looking at this new building that was going on. I was looking at, the short-term rental craze. I was looking at people thinking they were going to be millionaires from long-term rental, and I was looking at everybody screaming that there was no inventory when you look at the numbers, like that just didn't even make any sense. We have 15 million vacant properties in this country. Like, the boomers are retiring at 10,000 a day. Why would they want to carry multiple houses, with expenses growing when they could make 5% on short-term treasuries or in money market funds? And so I couldn't understand why everyone thought housing looked so great. So what I did is I got in my car because, kind of Logan and I wrote articles for the same series. His was very different than mine, as you
Yes,
imagine.
decidedly different.
But and honest, like you can read my article talked about pent up demand. Like nobody else was saying. I was like, no, we're going to have demand, and the builders figured it out, and the way that they got through it is through net price reduction. So the reason some of the prices have stayed where they were is because of all of these buy downs and concessions. But so I know I'm
Can I
saying
just
a lot. Yeah, go ahead.
Yeah, no, that's I just want to just slow it all down here,
Yes.
for the sake of the listener, and just say again, so this what time period was it where you wrote your great article for Housing Wire?
So I wrote it. It got published in January. I wrote it in December. Yeah.
All right, so we're now, close to a year away from it.
Yeah.
And so going into that, you bring in all of the experience that you just spent the last 10 minutes um, explaining, which is awesome. But what was your guiding philosophy going in? You just didn't really believe what you were hearing or seeing in the residential market, correct?
Yeah. And I think that that's like all of my instincts from having been here before, right? Just a little
Mm-hmm.
bit. Like I just kept asking kind of people in my industry, like, this isn't good. Like, we're seeing these double digit increases in prices. Like it's going insane. Right. So, I just couldn't, and nobody was as concerned as I was, which kind of set alarm bells in my head because these are people that should have been a little bit more reasonable. So I kind of felt like some psychology was coming into play. But so that's kind of I based on my research, I could not see how based on the fact that property taxes and insurance were going up, that we had already started to see borrowers start struggling in December of last year. But that's a seasonal thing. They typically get caught up with
Sure.
tax returns and bonuses. But I knew long term, and that's the thing where I think I might be a little different than some, is that I'm more concerned with the path. I'm not really concerned with predictions, and I could just tell long term we had serious headwinds for affordability, even for people that actually did qualify for these mortgages, or for the investors that paid all cash, because we knew that a lot of those investors, that was leveraged cash. Sure, some of it wasn't, but a lot of it was where they refied out of a bigger property, or they took out a home equity on another property, or somewhere like PNC sent them a note from their wealth management division saying, listen, take a personal loan so you can show up with all cash. And so I was really more concerned with that class of, and not even mortgages, but I could just tell from the investor speculation that trouble was ahead. So, that's kind of when, and I'm a validate your assumptions kind of girl. Like
You're definitely a boots on the ground kind of gal.
exactly. And so I woke up in, kind of late January, early February, And Joe from Bloomberg was like, the housing market is turning around. It's all going to be golden from here. And I was like, oh my God, like everybody's crazy. And within 3 days, I decided to get in my car and drive to Austin because I knew that was kind of the epicenter. And if I could, because I was looking at the permits, I was looking at all the data. That was what was just driving me insane. And none of the pieces were making any sense together. And so I had to go see for myself.
You were looking at the permits being pulled by builders and or developers for
Yes.
residential and multifamily, or
Yes.
single family and multifamily residential?
Yes, both of them.
So you jump in the car, you decide to go validate, go to Austin. We all love Austin. So I
Yeah.
I'd have gone there with you.
Yeah.
But so what did you discover when you got there?
Yeah, so I stopped in Nashville first on the way to Austin, and I was, you could hear stories at that time on social media about exurbs, which are these ideas that people, went 40 miles out of the city in a cow pasture and started building homes because they thought people would want to, that would be the affordable option. Well, the cow pasture homes were not affordable. That's what I found, so kind of my methodology is I do the perimeter of a city, drive out from downtown to these places so I could get a sense of what's the commute, what's the traffic like, and then also how many new build sites are there. And it just as I drove the perimeter of Nashville, you go a couple of miles, there's another one, a couple of miles. And I was like, oh, okay, this is worse than I even thought, and then you go to these things called mega sites. I don't know. I mean, they were new to me. I had never seen them before, where you would go and all the builders were there, the nationals,
all on one site,
plus the locals.
Sure.
And there was just a ton, like these whole little cities were being built. The idea that you could live, work, play here, clubhouses, all this, but it's all out in the middle of nowhere with no infrastructure. And so I was like, okay, this is pretty bad. And then the multifamily in Nashville. And I swear that first trip is such a blur. I feel like I have to go redo it because I had no idea what I was doing. But I would come upon this massive multifamily complex, completely vacant, completely finished. And nobody was talking about this.
And it's all luxury, right? It's not like affordable multi.
Yeah, you're going to make me start screaming. But anyway, sorry. But it's all luxury. And I was like, what is this thing? Is this Evergrande? Or am I in China? I was just like, is this a bridge to nowhere? I don't understand. And, and you would see across, and this was my very first trip in Nashville, across, and I can't even remember the area now, but from this huge multifamily, it was a brand new strip mall. Probably, 16 to 17 locations, and only one was rented. And one thing that I can tell you at that trip, I saw a lot of coming soon signs, a lot of coming soon 2022, coming soon, it was 2023. And I think a lot of people could explain that to themselves that, oh, it's all the, the disruption from the labor markets, things are just delayed. So it's coming, it's going to come. So I left Nashville and, drove through the floods to Austin. It was a crazy trip, by the way. And I get to Austin and I still can't articulate the first mega site in Austin I went to was called Sweetwater. And it was a complete accident. I was driving into the city, picked up my cousin because I had family there, driving in, and I looked to my right and I'm like, what is that? And I turn in and it is just, $600,000 to $3 million homes being built up into the hills. Nobody was there. And I probably stood in the middle of that subdivision for 5 minutes, just I couldn't process. Like I was like, this isn't true. This isn't happening. Because how could it happen again after we talked so much about, the overbuilding last time, the mania last time? Like it was very difficult to accept. So go ahead.
Yeah. So, what really strikes me as you're speaking there is that, I sort of lived through a lot of this. And I told you I'd recount the story for you quickly as when you came on the show. Um, I was listening to Lynette Zhang the other day from ITM Trading, and she's quite a character. But one of the things that she was talking about was just sort of the factual knowledge of the market, which I'm sure we're about to get into, versus sort of the what I see and feel. And I think a lot of times, people can get caught up in sort of the spreadsheets and the facts, which is great. But it's when you go out there and you stand amongst it and you say to yourself, hold on here, this doesn't make sense. It just doesn't look right. It doesn't, I can feel it in my gut.
Exactly.
And so back in that 2010-ish time period, I get a call from a buddy of mine in Utah, brilliant rehabber, fix and flip guy. And he said, man, the spreads in Phoenix right now are insane. You've got to come out here. So it took a ride out to Phoenix. And what we saw back then, Melody, was, I'm sure a lot of what you saw was these mega sites in the middle of nowhere. We're not talking Phoenix proper. We're talking out in like Gilbert and Queen Creek and Apache Junction, which, surprise. All of those places which are now built up. However, back then they were just pig farms. You could still smell the pigs.
You still can in some, Craig. You still can.
And so you get in your car. I'll never forget. And I wasn't a guy who had known a whole lot about Arizona. We live here on the East Coast in Maryland. So here I am, get off the plane, get a car, jump in, and you're an hour and a half or a good hour at least from the airport getting out to these sites that are in the middle of nowhere. And you'd go and you would see, here's what you would see. You'd ride up and you'd see the big cinder block fence that surrounded the entire development with a nice entrance. And then it was like, mains sticking out of the ground and one house.
Yes.
And then it was like 6 more mains and lots. And so what we were doing, we were buying these houses after the bust that were built for $350 in 2007. We're buying them for 85 grand at the courthouse steps, going in and patching them up and painting them with a little granite and carpet, selling them for $160 on, the following Monday.
Right.
And that went on for a good 6 or 7 months until, every investor in the country decided that they wanted to also come to Arizona. But the point of bringing it all up, Melody, was we did the same thing in Chicago. We did the same thing in parts of Florida, where you just could ride into these developments that were out in the middle of nowhere and say to yourself, this can't last. And so I'll finish up by just a quickie here. My wife and I were seriously considering earlier, right around the time where you wrote the article, moving to Florida. So we go down to St. Augustine, where they have decent school systems. And we ride into these communities where we're doing 10,000 houses here. We're doing 15,000 houses here. We're doing 7,000 houses here. And you're like, holy shit, are you kidding me? Like, where's all this demand coming from? And so, I haven't been down there, but I was just reading that St. Augustine is one of the, largest declining markets in the country right now.
Yeah.
So go ahead. That was a long way of me saying, I feel your pain, and I've been there with you out there driving the streets.
I think you would be so frustrated, Craig, because you would go back to like Buckeye, back to Phoenix, back even to Gilbert, further over, and it's the bridges to nowhere again. You come into a subdivision, the walls, like you say, are built up, the basketball court for the playground, and then the flags are whipping in the wind, the tumbleweeds are, it's just like one of the most bizarre experiences. And then, over there in Surprise and in that area, I mean, again, they just went crazy in between the feedlots, but no infrastructure, none. And the craziest thing about Austin, and one of the excerpts, way out in the middle of nowhere, 2 RV camps down the road where retirees are living because they can't afford to live anywhere else. Homes selling for $400,000. Median income was around $40,000. Nothing there, no gas stations. But you would go in a subdivision, and none of the houses were finished, except you'd have this one little lone house, and it would have a for rent sign.
Right.
Because some guy bought that house. Like he said, hey, broker or somebody, I want to buy an investment home in Austin to do long-term rental. And somebody said to him, there's no inventory. Okay, well, I'll build one. Let's build one. And that's what a lot of these individual investors took: a brochure, a pamphlet, and kind of said, yeah, I'm going to get my Austin, Texas long-term rental, or I'm going to turn it into short-term rental because, one of these programs, I won't mention names, tells me I can get an average daily rate of $600 a day. Well, wait a minute. That's 30 miles from Austin. There's no amenities, and
Mhm.
nobody's going to stay out there for an Airbnb when you've got 14,000 Airbnbs in Austin. So people just had all these, what I call COVID fever dreams about getting rich quick. And I don't blame them, right? Like, the idea of being able to do something besides, sell your soul to corporate America is, I want to do that, whatever that is as well. So I
Sure.
understood it. But, Austin was it was just overwhelming. Like, cause you
It
would
is
go
overwhelming.
downtown and so it was everywhere. The excerpts, like this is a funny story. I maybe shouldn't even tell it, but one investor built this whole huge community out in Manor, Texas. I shouldn't have probably said the name, but anyway, it's very close to the highest percentage of registered sex offenders in the country. And they had no idea. And now it's completely empty. I mean, completely empty. And
Talk about
so,
your amenities.
right. Okay. Yeah. Well, we can stop there, right? Because but it just shows you. That's when I realized, like, we have been taken over by the speculation, genie. Like, everybody has gone a little bit crazy.
So is, well, there were many causes of the Great Recession, not the least of which was overbuilding. Do you think that we have been quietly overbuilding at the same level as 20 years ago, or whatever it was, 17 years ago?
Yeah, so my answer is probably going to be controversial, but I think it's worse. I think you look at Lennar, we can take them in particular. There was a great article in 2009, that was all about their tax bailout, because I think a lot of people forget they kind of got bailed out last time. And it was talking all about this exuberance, how they went crazy, they've learned their lesson, and talking about their biggest year where they delivered 38,000 homes. Okay. They're on pace to deliver 2 times that, if not more, this year. So,
Mm.
What a lot of people are doing is they're looking at history and they're not taking into consideration our demographics. And they also don't understand that we pulled forward demand during COVID. There's a great Harvard study out there. And this is borne out by just talking to people. It blows my mind, but I'll talk to a couple that says, oh yeah, we each bought a house, but we don't use the other house, and it's pervasive in a certain segment of our population, which I think is what is so confusing about this time, why the consumer seems so strong, because that top 20% is still doing okay, although I am seeing the super prime start to come under stress. But they have options, right? Like, I have 9 properties in my portfolio. I can let go of one. Whereas, 60% of Americans can't afford $1,000 emergency. That's a whole different conversation when they can't, when they come under stress. It's a lot more dire. And so I think, we're a tale of two economies, Jack, in my opinion, to what you were saying earlier about the consumer seeming strong. I think that top 10, top 20%, they are still strong. And there's some reasons for that, like the ERC tax credits, things like that. Money was still being pumped into the economy until really last month when, the government decided to stop and start auditing those ERC rebates. And I don't know, Craig, how familiar you are with those, but so,
Quite.
yeah, so,
You're seeing commercials on
you
TV,
can't,
billboards for employee retention
exactly.
tax
No
credit.
guy, I know guys that have created companies around those damn things.
Dude,
There
yeah,
you go.
the last legit application was a year ago. Like,
Right. Right. And we just kept pumping the money in. Like, and you can even
Yeah.
look at, Danielle DiMartino Booth. I don't know if you guys know.
Yeah, I'm
but
a
you can
big
look,
fan. I'm a big
yeah,
fan.
you can look at one of her charts of like the travel chart. It matches the ERC rebates exactly. And so, we don't know yet what the economy looks like without money being pumped in, because it was being pumped in all these little sneaky places, even to the point like student loans weren't actually you weren't looking at outstanding debt. You were looking at a $250 payment when you were writing a mortgage. I mean, so there's just so many things that everybody wants one answer, and in reality, it's just a very complicated picture, you know. So
So
anyway,
let me
Jack,
let
go
me
ahead.
yeah. So
Yeah,
like let me because I agree with the obviously I agree it's like two different economies. From the housing market perspective as well, though, do you think that we've overbuilt? I think it's also there are multiple markets. They're all price points, all geographies do not act the same.
absolutely. Yeah.
Do you think that we've overbuilt, period, or do you think that we've overbuilt the $600,000 plus house? Because particularly with that demographic, the demographic thing that you picked up, I think affordability, obviously, especially where mortgage rates are right now, has become the primary driver for the low levels of demand that we have right now. A recession would exacerbate that. I do agree that, like, I'm broad brushing here. If you're $600,000 in California or Seattle, it's a different thing than being $600,000 in
Oh, of
wherever,
course.
Kentucky. But
Yeah.
I do agree that I do agree that they've overbuilt the $600,000 plus um, price point, but there's a complete dearth of 300 to 450 new construction, and something
Well,
that even that I was hearing as a theme. Ivy Zellman, I know you follow her as well. Her housing conference, I think it was a month ago, online housing conference, referenced that a theme on that was that the builders are now shifting down to the more affordable price point because where these mortgage rates are, there's just not enough demand for us to continue to build $800,000 houses.
yeah.
So do you think that it's is your concern segmented by price point? Are you less worried about the more affordable segment and more worried about the higher end segment? Or do you
Yeah.
think this is an across the board problem that we're going to see issues regardless of price point?
So I think we're going to see issues regardless, but it's a structural problem, like you're saying, Jack. Like, to me, yeah, if all those homes being built out there were being built at 250,000 or 300,000 or 350,000, then I guarantee you there would be demand for that.
Mm-hmm.
I mean, because I would buy a house then. I'm refusing right now, but I would buy a house, and so there's structurally, we have built too many overpriced homes. I think we will have an excess of inventory regardless because of these boomer second homes. And there's a lot of second home ownership in this country that I just don't think is going to be sustained due to kind of rising costs, insurance, taxes, et cetera, unless we have a price correction. So, if all things kept going forward, we don't have affordable housing. But at the same time, when you look at what's actually being constructed out there for $400,000, $600,000, a lot of these look like homes that, I wouldn't have paid $200,000 for, and they're being very cheaply built at the same time, similar to the McMansions of last time, right? And so really what they've done is try to spruce up what is a starter home and make it look like it's luxury when in reality it really is just a starter home. And so I think that if there was repricing out there, I think a lot of this inventory would actually get bought.
Cleared.
But until that happens, there's going to be this frozen market. But the builders have affected a 15 to 25% price reduction. I mean, that's how they've gotten through the last year. And they're going on overdrive right now. Like, some of the, advertisements we're getting are just kind of insane. So it's a complicated picture. And you may know, Jack, I track 70 cities because real estate's local till it's not, is kind of what I say. And I think each of these cities will be impacted very differently. But back to what you were saying, Craig, Florida by far is, again, and it's just hard for me to believe because I spent 2012 and 2013 down there cleaning up the default mess. I mean, I can't believe my eyes in Florida again, but because of things like the insurance 4 times the national average and people waking up to like 2 times insurance bills and then the taxes because it's on assessed value, and then for new construction the CDD tax. Like Florida is just in a world of hurt because they haven't stopped, Jack, building in like Lakewood Ranch, $1 million homes. They haven't.
It's where my in-laws live, by the way, in Lakewood Ranch.
Yeah, they have. I mean, I can't even fit the video anywhere. Like I'm trying to work with someone to get it because you simply could not believe your eyes as you just kept driving and driving and driving. And they were, and in Lakewood Ranch in Florida in general, it seems like the difference between when I was on the road in February and March and when I was just recently down there is that they're actually accelerating construction. A lot of the sites down in Austin and Florida back in February, because I went to Florida, like after I was done with Austin, I went over to Florida the first time. Not as many workers, like they were, but this last time, ton of workers. It looks like they're pushing to year end.
So how do you explain that though? I mean, these are not dumb people, right? You can only kick the can for so long until you're just like, hey, this is stupid, stop building, right? Like they don't have to build the next house. And they're not going to build up Wall Street won't let them build up an unlimited, a massive amount of unsold inventory, especially on spec. Like they're not going to have spec inventory for longer than 6 months. They'll just stop building.
No, they don't. They haven't. I mean, and so I've heard, because I kept asking these same questions because I actually know a lot of these people at the builders because they're in my industry. And I called a lot of people from the road, by the way, saying like, can you believe like what is going on? And they would acknowledge it, but they would acknowledge the larger problem. So Jack, every time I listen to a earnings call, I get half convinced again because they really good at the gospel singing about what they learned from the last crisis. But all I have to do is get in my car and go to one of these new build sites. And by the way, there's maps of them. You can find them easily. To realize like that none of that, the idea that they're smarter than this now, that's just not accurate. They're not seeing, when you look at things in aggregate, that's what a lot of people are doing is they look at the aggregate numbers. But there's been some cool things I've done in my Substack recently because we know the Fed doesn't track cancellations. And so a lot of that inventory that people think, was
putting
sold.
Contracts.
Was
putting
canceled.
Contracts,
Yeah. And so essentially you've got completed homes for sale growing exponentially. And then the second thing that, Jack, you may not be thinking about, because I hear you, is the build to rent. So everybody went crazy on build to rent, but what's happening is American Homes for Rent and the bigger players are becoming net sellers. Yeah. So I think a lot of people, when they think about it, they don't think about single family residence and single family rental together. And that's what's happening is you've got so many of these single family residents built to rent and the multifamily, but now renting is cheaper than owning. And so you've got a competitive competition that I think a lot of people aren't used to, and they don't understand that, and then you have the short-term rentals. We can't forget those because some of those will come onto the market. That's all going to pull away from what the builders are building. And so I think people aren't looking at housing stock in total and aren't understanding our changed economic dynamics that are a little different this time, where it's cheaper to rent.
But isn't
hey Jack, I'd like to drill in on a bunch of that there. We got about a minute and a half that we can play with in this particular thing. It goes fast. And we'll restart for the next episode, and we can jump back in at that point. But one of the things I really want to jump in there with you, Melody, is this sort of financial shell game that I feel like the builders are playing with. Permits versus contracts versus land. You mentioned that, I believe, in one of your most recent episodes. I think it was on Wealthy On. So I'd love to jump into that with you.
Sure.
Why don't we end it here and ask everybody to jump in for what should be an even better conversation on the next episode. This is Real Investor Radio, and we're coming back on the next episode with Melody Wright. So come on right back. We'll see you then.